Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us gold has been rallying, but silver has not. He also isn't happy the price of crude is going up because oil tankers are being attacked. Trends Journal publisher Gerald Celente takes a look at how the world economy is doing. He says people in the U.S. are still applying for mortgages like crazy. Author of the book, Banking on the People, Democratizing Money in the Digital Age, Ellen Brown, calls for a radical shakeup of the banking system and how universal incomes could help wipe out personal and government debt. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABN.V. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, did gold hit a special mark, or is it trying to?
It is just trying to push through this 1350 to 1360 range, and it had it had the extra little push on Thursday, Friday, as the two of the tankers were hit in the Straits of Hormuz. And that created a bit of a surge in the price. But, we know historically that any time that gold and bonds and the dollar rally on a piece of conflict news, that usually that's short-lived. So if gold's going to try and push its way through resistance, I'd like to see it do it on its own without a catalyst point such as this. And, that might be the break of the dollar index below its support around 96.5. The dollar closed off the week around 97. So the dollar's still in an uptrend, but if it starts to give up ground, then that clearly means that gold pricing can do much, much better. But gold on a relative basis, when you compare it to its silver market, that everybody loves to look at the gold-silver ratio, silver had a pretty rough end of the week. Couldn't manage to hold the gains that it had there on Thursday and early Friday. So we're in one of those situations where, seasonally, the gold market typically, when it is put in a early June low, you can expect to see a 5 to 8 week rally, and it can have a lot of chop within it. So, we're a week and a half into this move. I think there's still more upside bias, but it's going to take a bit to work its way through that 1355 range, which has been the overhead resistance since back in 2014.
What are we seeing in the markets, and are they setting up for something?
Well, I think they are. We take a look at the correction that we had into May, early June, as far as the equities were concerned. You had a nice oversold reading. You're within a rising trend, and then you've had a good rally back in this last week. Actually, one of the better rallies that we've had off a bottom. So with this type of volatility, especially in this point in the 4-year cycle, as far as the presidential cycle is concerned in the States, when this rally loses its momentum, and that we have a means of measuring, as it loses this momentum, we can be looking for upwards of a 10 to 12% downside correction as far as the equity market's concerned. And if we get a bit of a rolling top in here in the U.S. equities, say between now and the early part of July, then you're probably looking at an August corrective low, and ideally around a 10% drop or more. We've got the various technical factors in place to set up for the top. All we need now is this change in momentum, and we'll be sending that alert out to subscribers once we get it.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Gerald Celente next on This Week in Money.
Always consult your investment professional before making any investment decision.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He's speaking to us from historic Kingston, New York. Gerald, it's great to have you back on This Week in Money.
Always great being on with you.
Gerald, for those who are new to the Trends Journal, what's it all about?
Well, it's the only magazine in the world where you'll read history before it happens. We have tomorrow's news today. And it's the only trends magazine out there that really looks at geopolitics, economics, anything from healthcare to technology, you name it, we cover it. So we look at the current events forming future trends, and we're political atheists. We look at things the way they are, not the way we want them to be. And when you subscribe to the Trends Journal, there's not one advertiser in it. So we don't get paid what to say.
Gerald, is there resistance for gold? And if gold goes through that point, what could we see?
Well, I've been saying the same thing for basically 6 years, that gold has to break over $13.85 an ounce. It's getting close to that. It's nearing the $13.50 mark as we speak. And once it breaks past that, the next breakout point is $1,450. Again, I've been saying this for 6 years. And once it breaks past that, then we believe it's going to spike to the 2,000 mark. We sent out a trend alert. That's the other thing you get when you subscribe to the Trends Journal. It's not only a monthly magazine. We do trend alerts, and we have podcasts 5 days a week, Trend Vision 2020 and Trends in the News on Friday. And what we're looking at is the bottom of gold. We just sent out a trend alert that the bull run has begun, and that's our belief, is that our forecast that this is the beginning of the gold bull run. The downside risk is minimal. It's in the 1270 range, and in the futures markets, that's very small. It's a very small risk, 1250 at the worst. So we see a very low downside risk and a very high potential.
Is there anything in particular that would trigger a big boost in gold?
And current events form future trends, and you're seeing it right now. And what happened with the oil tankers being sabotaged a few weeks ago in the Persian Gulf, and now another one. And the Trump administration is blaming Iran for the latest tanker attack in the Middle East. And as we've been forecasting, again, in the Trends Journal, you go back to our 2018 top trends. One of them was market shock mass murder. And what we said was that the United States, Israel, and Saudi Arabia were aiming to take out Iran some way or another. And now you're seeing that happen. So when we see oil prices spike, if war breaks out above $100 a barrel, and again, we've been saying this now for going on the better part of a year and a half, if you see oil prices spike to that level, you're going to see global economies crash and equity markets to follow. And that gold, again, that will break past the 1450 mark and spike to the safe haven 2000 plus mark, because the markets, the equity markets, are way overvalued. There's over a $250 trillion debt bubble that's been artificially pumped up with this monetary methadone, this cheap money that they keep injecting into the bull. And that will end. And when that ends because of a wild card like war and spiking oil prices, that will bring gold prices up. The other one, of course, is if there is no war, and it'd be wonderful if there's not. I don't say hope, because hope is, it means nothing. It's like hope and change you can believe in, And hope is just an empty phrase, but I would love not to see war, being that I launched Occupy Peace. But the other thing that's going to bring gold prices up, and what's been pushing them up, are lowering interest rates around the world and more quantitative easing. And whether it's in China that's doing it right now, and you're seeing the Yuan going down, or whether it's India lowering rates, whether it's Australia lowering rates and facing the worst crisis since the Panic of '08 in Australia, housing prices going way down 12% more in Sydney and Melbourne. That's the other thing that's going to rise gold prices. And you're seeing, tensions throughout the world, whether it's Sudan, Algeria, Mali. How about those protest marches they're having in Argentina, as you're looking at the inflation rate spiking above 50%, peso down more than 50%, unemployment skyrocketing, Venezuela's problems. So, it's global. And that's one of the reasons, among the reasons why gold prices are going up. It's a safe haven asset.
Does the U.S. dollar need to go down for gold to go up?
Yes, but the thing is that the dollar's going down, but so too are the other currencies. I mean, you just heard last week that Mario Draghi, the ECB chairman, European Central Bank, saying they're going to use all the tools in their toolbox to pump up the markets. You're looking at Germany now saying that their GDP this year is only going to grow about 0.6%. So, the euro is basically stable right now, but why would I go into euro or yuan or rubles or pesos or anybody else's currency? So the only reason the dollar's maintaining any kind of significance at all is because of the massive problems that other nations have that are even worse than the United States.
Somebody said it's like the U.S. dollar is the cleanest, dirtiest shirt in the laundry basket.
That's accurately put.
What's the outlook for oil, or can you predict it if there's trouble in the Middle East?
Well, the other thing, too, is I do not believe Iran did this. It's like the phony information they put out that Syria used chlorine gas, and now the data the prostitute media refuses to report it, that they didn't use it and it was set up by those white helmets, and their proof is there. And why would Assad do that when there's victory at hand? And why would Iran do this, knowing that the United States has been targeting it so obviously for the last 2 years? So the issue being is that, oil prices can spike and war can break out, and they're going to blame anybody they can for it. But the reason, just go back, earlier in the week, oil prices were down. One day they dropped 4%. Why? Because there's a global slowdown. And now they're spiking again because of this fear. So I don't believe Iran did it, and I believe that they're going, just as the Gulf of Tonkin incident never happened, just as Saddam Hussein didn't have weapons of mass destruction. And of course, if you go way back, remember the Maine? It's one lie after another. So why would anybody believe what they're being told?
Does silver have a resistance point?
I don't know the resistance point, but silver basically follows gold. But if economic conditions really deteriorate terribly, silver is also used in an industry, and that's going to hurt the price somewhat. So, but But overall, I believe that, given the past record, silver follows gold.
Are lower interest rates predicting a recession?
Absolutely, and I believe they should lower them already, because look at the numbers that came out in the U.S. last week with new jobs, only 75,000, and downgrading the previous 2 months, and you're looking now at more and more data showing weaker and weaker economic growth. So it's a global slowdown, and the only way they're going to prop it up is with more monetary methadone, more cheap money. And at some point, the bull is going to OD, but they're going to keep coming up with schemes on trying to pump this up. And going back to oil, the point I wanted to make that I didn't when we were just talking about it is that I mentioned that you have countries like Saudi Arabia and the Middle East countries, United Arab Emirates, etc. Saudi Arabia needs oil at $100 a barrel for its economy to break even. And what are we looking at now? Brent crude around $62. So could they have done it to drive up the price of oil? So could the United Arab Emirates have done it? Could one of the other countries have done it? Could the United States have done it? So they need to drive up oil prices in the Middle East. They have some real problems there because they have no other forms of economic growth virtually. So blaming Iran is one thing, but if they did it, that could be a real thing.
We'll have more with Gerald Celente when This Week in Money returns.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Gerald Celente. Gerald, could a global recession happen without the United States?
Yes, it's already happening. I mean, China's dumping a lot of money, lowering their reserve requirement ratio so the banks can loan out more money. Again, as I mentioned, you're seeing the Yukon dip. India, a report just came out that they're fabricating their levels of economic growth. And there's a slowdown in Europe. There's a slowdown around the world. So the United States could stay out of it a little while longer because a lot of these countries don't have room to lower interest rates. China, of course, does, and so does India, but that's not going to do it as much in the United States because they raised interest rates, 9 times since 2015. They could lower them 9 times. So I believe we're going to see this within just a few weeks. I believe the Federal Reserve is going to start lowering interest rates. So the United States has more room to do it than most other nations, but it still might not be enough. So the recession will hit the United States, I believe, after it hits the other countries. For example, you're seeing new mortgage applications in the United States skyrocketing as the 30-year mortgage had dipped from, it was around 5% in November of 2018, and now it's hovering just above 4%. And I believe it's going to go lower. So that'll boost housing, it'll boost car sales, and it'll also boost borrowing at some levels, and particularly for the bigger companies that do mergers and acquisitions and stock buybacks.
With governments passing bail-in legislation to bail out failing banks, where can you put your money to keep it out of the hands of the government?
Well, again, I don't give financial advice, and to me, only speaking for myself, at this point, gold is the safe haven asset that shines the best for me.
Are new car sales declining?
Declining somewhat. Where they're really declining is in China. China is really way off. This is another bad year for them. They had a terrible year last year, and it was the first year of a full year decline in car sales since the 1990s, and now they're set for another one. The first 6 months of this year have been declines. So I believe globally there's going to be one. There's a slowdown, so it's just a matter of time. And as interest rates again go down, it might boost car sales a little bit. But then you look at the data. You know, the millennials, one of the biggest generations, right next to the baby boom in terms of numbers. You're looking at the data coming out time and time again, how much their income has decreased. They can't afford to buy houses. They can't afford to buy cars. They can't afford to buy much of anything. Can't afford health care. So it's only going to get worse.
Are slower auto sales also an indicator that consumers already have too much debt and are tapped out?
Oh, absolutely. Look how many years now it takes to pay off a car. They just keep extending how long it takes. Things aren't worth anything by the time you pay it off. It's kind of like a college education. That's the other thing with millennials. You're talking, $1.5 trillion worth of college debt in the United States. It's unprecedented. They're going to die being in debt, and many of them will never pay it off.
Do you still see Beto O'Rourke winning the Democrat nomination?
No, we changed that forecast in the last Trends Journal in our May edition, and it looks like Biden right now, but there's a lot of time left, and so it's difficult to say. But if Biden and Trump run, it's a toss-up. It's going to be really predictable on the swing states, like Pennsylvania, Wisconsin, Michigan, because we have an electoral college, and that's how Trump beat Hillary Clinton. He got less votes, but more swing states. And he has a problem fighting Biden with that, because Biden is very popular in places like Pennsylvania, where he was born, and other swing states. So it's up in the air right now. And the bottom line is going to be the economy. As the Clinton administration used to say during the campaign back in 1992, it's the economy, stupid. So if the economy is somewhat strong, it's going to be a positive for Trump.
Are the globalist ideals of the European Union coming to an end?
In some places they are, but we saw with the European parliamentary elections that while there were significant wins in Italy, in other countries there weren't. France had some strong wins in that area. Other countries didn't. So it's a mixed bag right now. Italy's going to be the canary in the coal mine. They're the ones that could really break it. And they may do that by going deeper in debt against the European Union, telling them not to. And there's more and more of the populist movements that want to pull away from the Eurozone. But at this moment, there's a bit of a reversal, because when you look at the parliamentary elections, the Greens parties also took quite a big number of seats from the established parties.
Is President Trump using the art of the tariffs to get the best deals for America?
Oh, absolutely. There's no question about it as I see it. And, I don't agree with Trump on just about anything, but I do agree with him on the tariff, not on the tariff issue, but on the trade issue. We're running up enormous deficits. Who would do this? But it's not really China's fault. It's the corporations, the North American and European corporations, that gave the technology to China back in the 90s and early 2000s so that they could get their products made there cheaply and then bring them back and mark up the prices. So they gave them the technology. China didn't steal it. And the deal is, if you want to open up in China, yeah, you could open up, but you can't own the company. You only could be a 49% partner. So I believe in Dr. Paul Craig Roberts when he says that we should be taxing the Nikes, the Apples, the Levi's, etc., who are the ones that are benefiting from it. It's not like we're buying Chinese Nike sneakers or Chinese Apple products. They're American products getting made over there, so the companies should be taxed.
What do you see ahead for the Dow?
I think it's peaked. That's our forecast. It's near its peak. It may go a little higher, but it's about washed out for a bit.
Is China's economy getting crushed?
Oh, it's going down. There's no question about it. As I mentioned, they're doing a lot of stimulus, and it's not really boosting a lot of things other than the housing market, which is a big one for them. But when you look, for example, at imports, in the last numbers that just came out, they were way down. And 80% of China's GDP is consumer-based. So that import number should have gone much higher. But again, as I just mentioned, look at their car sales. They keep slumping into double digits. So it isn't collapsed, but they're in trouble, and they're going to do more to keep building it up.
We'll have more with Gerald Celente when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Gerald Celente. Gerald, are people waking up to realize governments and the media have been corrupted?
Nah, in some places they are, they're not. Overall, you know what I call the people in the media, I call them prostitutes, because they get paid to put out by their Washington whoremasters and corporate johns. There's no free media anymore. You know, I used to be on everybody, from Oprah to the Today Show, Good Morning America, you name it, many, many times. And not anymore. They bring on their paid consultants, advisors. It's all a rigged game right now. It's the same stupid story every day. And that's why people subscribe to our magazine. We don't care about the Mueller report or Barr or this one or that one. That doesn't help you prepare for the future. So they're not giving you information and news that will help you prepare and understand what's going on. Rather, they're giving you junk news and then their opinions on it. So it's only getting worse.
What's the latest on real estate?
Well, again, in the States, real estate is going to do a little better because interest rates are going to go down. And Trump knows that. You know, he's in the real estate business, and that's why he keeps pressuring the Fed to lower interest rates. So the real estate market will boom up a little bit more as interest rates go lower. Unless, of course, a crisis breaks out, a wild card crisis like war in the Middle East. And that could be the beginning of World War III, excuse me. And as Einstein said, he doesn't know what weapons will be used to be fought in World War III, but he does know that sticks and stones will be used in World War IV.
What do you think will spark Third World War? Where will the hot spot be?
Well, the hot spot is definitely the Middle East. There's no question about it. It's going on, hasn't stopped, and it's only getting worse. And by the way, this is merely the 10th crusade. It's been going on for a long time.
What's the latest in health news?
Well, the latest in health news is we're looking at a lot of these plant-based products that are getting people on a different trip. And while they talk about people becoming vegan and buying more and more into us, the numbers are really very small. In the United States, I mean, you're looking about 4 to 5%. But there is an awareness to it and more into that area. And, you know, the genetic engineering, of course, is going to be a big one, too. So those are things that we're looking at a lot. And, of course, it's brand new in the game. But on the other hand, the whole health healing trend is real, and you're looking at that with the cannabis boom, and even now mushrooms being legalized in different places. Because, as I keep saying, if the planet could feed us, could it heal us? So I think we're going to see more and more natural healing as well, with herbs and supplements that we haven't seen before being brought to a popular level.
They're detecting more and more pesticides and herbicides in our breakfast cereals and in the vegetables and fruits that we eat. Are governments doing enough to look after that?
No, what governments? They're not governments. They're corporations. Governments. You know, it's corporatism. Come on. Look who runs the agencies. You know, the people better grow up as I say, there's no, the Democrats and Republicans, try the Bloods and the Crips, or as I call them, the Crats and the Kins, the Dummocrats and the repulsive Kins. No, I mean, the government's not doing anything.
What's your latest globalnomic view?
Oh, the globalnomic view is definitely the Middle East and what's going on with oil prices, Iran, weapon sales that are increasing, and tensions growing between the United States, China, and Russia. Russia and China, of course, uniting on one front, and the United States going out against both of them. So that's what we're interested in seeing really calm down, because if that keeps exploding and growing at the way it is, it's not going to be a very peaceful or prosperous future.
What's the latest on Occupy Peace?
Well, we're in a standstill right now. It's very difficult to raise money. There's not a lot of concern about peace. And all you have to do is look at the presidential reality show in the United States. Of all the candidates on the Democratic side, only one of them, Tulsi Gabbard, speaks about peace, and most people don't know who she is. This other guy, Buddha Edge, or Bud Edge, whatever his name is, I mean, he was a former naval intelligence officer, proud as he shows his photo of him dressed up in his military drag with his AK-47 across his lap. And he just came out with a speech saying, we have to watch out about China, we have to build the military stronger, prepare for the next war, very different than and how we have to have force. So he's just a war hawk just like the rest of them. So there's not a big appetite for peace in the United States, and we see it with the lack of donations going into Occupy Peace.
How can people find out more about the Trends Journal?
Oh, simple. Go to trendsjournal.com, trendsjournal.com. And if you want to donate to Occupy Peace to make peace happen, it's occupypeace.com.
Gerald, thank you again for being on the show.
And thanks for having me, Jim.
My guest has been Gerald Celente, publisher of the trendsjournal.com. He was speaking to us from historic Kingston, New York. Coming up, Ellen Brown, next on This Week in Money.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Ellen Brown, author of the new book, Banking on the People, Democratizing Money in the Digital Age. Ellen's the founder and president of the Public Banking Institute, and you can find her blog, The Web of Debt, online at ellenbrown.com. Ellen, welcome back to This Week in Money.
Oh, thank you. Always great to talk to you.
Ellen, can you first tell us about your new book?
Okay, well, it's actually the third book that I've written 13 books, and this is my third book on banking. So the first book was Web of Debt, which was first published in 2007, and at that time it was sort of an unknown fact that banks, not governments, create our money. So that's what I was writing about, that this is a bit shocking fact, that most of our money comes from banks when they make loans. And the problem is they create the principal, but they don't create the interest. So when the loans get paid back, the newly created money is extinguished, but that you've still got the problem of the interest. So that money can only come from more debt, since virtually all money comes from debt. And therefore, debt always grows faster than the money supply. So you've got an unsustainable system, and that's why we have booms and busts, booms and busts. So then my second book, The Public Bank Solution, was about how we could fix that in large part by turning the banks into public utilities, so that we, the people, would actually get the interest back, and we could use it for social purposes or direct it into our local economies, make below-market loans, direct them where they need to go, and not just where large banking shareholders want them to go. In other words, change the mandate from serving the short-term interests of investors to serving the local community whose money it is, if it's government money, government deposits. And so this third book, called Banking on the People, the first half I showed that regulation really won't work. You know, we had the 2008 crisis, and the government bailed out the banks, but they didn't bail out the homeowners. I mean, the people have suffered at the expense of the banks. The system works for the banks, but it's not working for us. So how do you, and then the second half of the book shows that we're in a new age. We've now seen that banks can do remarkable things, that central banks can print money till the cows come home, and it doesn't necessarily create hyperinflation, that we could use that resource. That currently it's only used to prop up the banks, but we could use that very same resource and direct that money into the local economy to do all those things we need without creating hyperinflation. So I was just writing about the potential of what we now can see that the banking system's capable of, and what money really is compared to what we thought it was. We've always thought of money as being like coins or something that you have to acquire, and in order to borrow it, you have to borrow it from someone else. But now we know that banks don't borrow it from someone else. They actually create the money that they lend on their books. So really what money is just a monetizing or a turning our own credit, our potential future productivity into something we can spend now. And that has lots of potential that hasn't yet been exploited. So I was just writing on all the potential that we have for the 21st century monetary economy.
How is modern banking broken?
Well, the main problem is that that particular aspect that I was saying, where the banks create the money, the principal, but they don't create the interest. So debt always grows faster than the money supply. Michael Hudson has traced this. He's an economist who has written a number of books, and he's traced our money system all the way back to ancient Sumeria, which had the first written language and was actually a very sophisticated and technologically advanced civilization like 6,000 years ago. And it wasn't a gold system, it wasn't a barter system like people think, but it was really just an accounting system. And they did charge interest, but the emperor or the kings or their rulers knew that this system was unsustainable, that periodically the debts would overwhelm the system, and that everyone, all their workers would wind up in debtor's prison, and they wouldn't have anyone to fight their wars, and they wouldn't have anyone to tend the fields. So whenever there was a new leader, they would just forgive all the debts and start over. But we can't do that anymore because the debts are now owed to private lenders. So how we could fix the system would be to fill that gap between the debt, the collective debt, and the money available to pay it by something like a universal basic income, where you would give a certain amount of money to everyone every year. And so I've broken down the numbers and showed that we could actually do that without creating hyperinflation. And not only, it wouldn't be welfare, it would actually be a dividend, and it's actually necessary for a sustainable system to somehow fill that gap between the debt and the money available to repay it.
Is the printing of money likely to ever hit a wall?
Well, you could certainly print too much money, as we've seen in Venezuela, Zimbabwe, Germany, but all those countries were forced to print money because they had debts not in their own currencies. So if you're a sovereign government, printing your own money, issuing your own money, and borrowing in your own money, you won't go bankrupt, but you could still print too much and create some sort of hyperinflation that would not be a good thing, obviously. But you can avoid that by matching the amount of money you create with your productivity. So this is what China has done, for example. In the last 20 years, China has increased their money supply by 800%. So they have 8 times as much money floating around now as they did 20 years ago. So in theory, that should have driven them into hyperinflation. How could you do that without, driving up the price of things? But they haven't. In fact, their interest rate is just hovering around 2%, which is what we consider optimum. And the reason, again, is that they put that money into the local economies. So they've used it for infrastructure, like those high-speed rail that they managed to build all across the country in 10 years. How did they do that? They just borrowed the money from their own banks. They own 80% of the banks, so they could just issue the money as credit, build the thing, and then the proceeds from the thing they built goes back to pay back the loan. So it's all in how you direct the money. But if properly managed, you can just keep printing money without disastrous consequences. In fact, you need to print money. You need some new money all the time because of the way our money system is structured.
Private banking versus public banking, what are the pros and cons?
Private banking has a mandate to serve their shareholders. So, and of course they also serve their executives, their high paid employees. So if they had a choice, for example, between a hedge fund loan, like say a $5 million loan that went, or $5 billion or whatever, that went to a hedge fund, and a $50,000 loan to a small, struggling local business, they would always take the hedge fund loan because it's going to be a better pay, and it's actually a more reliable pay, but it's not serving the local community. So a public bank has a mandate to serve the public, so it would make the $50,000 loan, which would, I'm talking about perfectly good loans that will pay back, but they're not real lucrative, but there's something that the local economy needs. So a public bank uses public resources, so it would use public deposits, public capital, and would leverage it for public purposes, and the profits would go back to the public. We only have one long-standing example here in the U.S., and that's the Bank of North Dakota, and their structure is that by law, all of the state's deposits, so all the state's revenues are deposited in the bank. So they have a massive deposit base that's a captive deposit base. They don't have to advertise for deposits. And they have a quite large capital base that they've built up over time. And they don't have to advertise for borrowers either. They partner with the local banks. So the local bank goes out and finds a customer or whatever. Maybe if they have a loan that's too big for them to handle, they will go to the Bank of North Dakota to partner with, to provide the capital to avoid losing that client, let's say, to a Wall Street bank. So the Wall Street banks have a very small presence in North Dakota, and they have 6 times as many local banks as other states. And they didn't lose any local banks during the crisis, whereas every other state, the local banks either went bankrupt or had to sell out to the larger banks. So it's a very sustainable system, and again, they have a mandate to serve the local community, so they make below-market loans into the local community. They don't gamble, they don't do derivatives and speculative things. Before 2008, it was thought that the local public banks globally, 25% of banks globally are publicly owned. So many countries have public banks, but before 2008, they were thought to be sort of the black sheep of the banking community because they weren't real profitable. They were serving their local communities and not trying to make money. But after the crisis, they suddenly got redeemed because the countries that had strong public banking sectors were the ones that breezed through the crisis. The public banks would lend counter-cyclically, so when the private banks were pulling back, the public banks were out there lending into the local community, and they were much safer than the private banks. So everybody was rushing to put their money in the public banks. We had an example in the 1930s, for example, with the postal banks. We actually had a public postal banking system from 1911 to 1967, and it was particularly popular during the 30s when all the banks were going bankrupt. So everybody rushed to the postal banks to put their money, and they made 2% on their deposits. So it was a really good deal and a viable thing. What Roosevelt's government probably should have done was to make that system stronger, but what they did instead was FDIC insurance for the private banks. So we, the people, wound up guaranteeing the private deposits of private banks. And so ultimately the private banks had a lot of leverage with government, and they managed to put caps on what the postal bank could do, and it eventually in 1967 it was phased out. But other countries still have postal banks that are quite viable, and there is a bill on now to revive our postal bank to serve the unbanked and the underbanked.
Whenever the government gets involved in something, quite often it doesn't go well. Is that a risk for public banking?
Well, sometimes it doesn't go well, but I would say more often than not it does go well. I mean, we need government. You need the government to build the roads. If you didn't get government involved, we would have been bankrupt long ago. I mean, we would have gone through the Depression and the whole economy just would have collapsed. Government rescued the banks, which we need banks. That's the basis of our money system. It may not have been the best solution, but it was a necessary solution at the time. So, but one thing that we talk about at the Public Banking Institute a lot is governance. That if you're going to set up a public bank, you don't want it run by politicians, of course. You want it run by seasoned bankers. But on the other hand, you don't want it run only by seasoned bankers, which is pretty much how the Federal Reserve is run. I mean, it's run by bankers for bankers, and it serves bankers, but it doesn't serve local communities. So you want some representation from your local community. So you want it to be a people's bank that actually represents the people with some representatives that have a voice.
We'll have more with Ellen Brown when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ellen Brown. Ellen, what kind of banking would work for all people, not just some of the people?
Well, theoretically, I mean, we would say a public bank would work for all the people. That would be the mandate, to make it fair for everyone. What I've written quite a bit about, have been several proposals by economists, professors, ex-Treasury officials, central bankers, that we are in a position now where we could actually all have an account at the central bank. Not that anybody trusts the central bank today, but let's assume that the central bank were turned into a true public institution, a true public utility that had a mandate to serve the public. Right now, only banks can bank at the Federal Reserve, and they are getting 2.5% interest on their reserves, which are essentially our deposits. That's their reserves, and we're getting nothing on our deposits. And we've got a $250,000 cap on FDIC insurance. So if everybody were able to open an account with the central bank, I mean, let's say it was through your local bank, but your local bank was hooked up to the central bank, we could all be getting 2.5% interest on our deposits. The central bank is a deep pocket that it can afford that, and I would argue we actually need that extra money in the system. You wouldn't have to worry about FDIC insurance because the central bank can't go bankrupt. You wouldn't need that $250,000 cap, which is really what has triggered the repo market and the shadow banking system, where large investors like pension funds, etc., large institutional investors that have more than $250,000 don't want to leave their money in a bank because they're not insured. So they put their money in the repo market, which is a different kind of insurance, where you have to post collateral. It's kind of like a pawn shop, so you post the collateral, and then if for some reason the bank goes bankrupt overnight and you can't get your money back, then you get the collateral instead. But it's pretty complicated, and I've written a lot about it, but you almost have to read a chapter to get the whole concept. But that is what collapsed in 2008. It was a run on the repo market, not a run on the regulated banks. So we could do away with that, which is really the riskiest aspect of our banking system right now, because you wouldn't need it for the large institutional investors, and you wouldn't need it for liquidity, because you would have the central bank, the deep pocket of the central bank for liquidity. So you could redo the whole system in a way that's more logical, more efficient, eliminates the risky aspects, and eliminates the fraudulent aspects. Right now, the whole system is really based on sleight of hand, where banks are pretending to have money they don't really have, and that's why they go bust periodically, where they pretend that they've got your deposits safely right here at the same time that they've lent the money out. Well, how do they do that? They scramble around and they borrow the money from somewhere else. But if their overnight, their short-term liquidity dries up for some reason, as it did in 2008, 2009, then they go bankrupt and you can lose your money. But we don't need all that. If you saw that all money is a monetizing of our future, our own credit, our own ability to pay back in the future, you could draw that liquidity from the central bank, which is a deep pocket, and stabilize the system. I can't really explain it too well in 5 minutes, but I've written whole chapters on it to explain how that might work. And there are these proposals out there by quite credible authorities that's how we could do our future system.
Are nations being looted through the use of central banks?
The central banking system was set up originally it was originally set up by bankers for bankers as a reserve system, a backup system. So that's not a bad thing. That's a good thing. The Bank for International Settlements, which is where the rules are made in Switzerland, it's a private entity, and it's got shady aspects to it, and it was set up originally by the Bank of England to recapture economically the colonies that had been lost politically, but they wanted economic power the financial power over their colonies. So at first it was the Bank of England was the head of the system, but it was a private system, and then it went to the Bank for International Settlements after England went through World War I and basically was broke and couldn't manage the whole thing themselves. And then now the Bank for International Settlements in Switzerland calls the shots, and it is a private system run by private bankers, and we have seen that they can do quite shocking things. Like in Switzerland, the Swiss central bank is now buying up stocks. Well, they can print all the money they want to buy up stocks, or the Bank of Japan is also buying up exchange-traded funds, which are collections of stocks. So they've gotten out of hand, and we've now seen, or even quantitative easing is a bit shocking. The idea that these are unelected bureaucrats that can make or break countries by their monetary policies. They broke Greece by forcing them into austerity to pay back something that, if Greece had its own central bank, they could have borrowed from their own central bank and issued their own money, etc. So the system is unworkable. I wouldn't say it's criminal, but it's not serving us, and it could definitely be improved.
Who runs the central banks, and should their power be taken away?
Yeah, well, I think they should be nationalized or be made public institutions, yes. The Federal Reserve is composed of 12 branches, all of which are 100% owned by the banks in their district. And the one that's most powerful is the New York Federal Reserve, which obviously that's where the big Wall Street banks are. So they are pretty much calling the shots, and they meet behind closed doors. For the Federal Open Market Committee decides interest rates and, determines policy, and we the people don't have any voice in that, and we don't even know what they base their decisions on. So I think all that should be changed. We the people should have a voice in the central bank. We should have representation on these district banks, and of course the Federal Reserve Board is appointed by the President and confirmed by Congress. But even there, once they've been appointed and confirmed, they're on their own, and we don't have much say over it. So even the President can just rant and say they should do this and that, but he doesn't really have the power to tell them what to do, and they're quite proud of being independent. So they're independent of government, but they're not independent of the banks. They're actually there to serve the banks. So that's a bad system, and we should fix that.
Is it kind of a trick on the people to call it the Bank of Canada or the Federal Reserve? Because it gives the impression it's some kind of government, people-led organization when it isn't.
Exactly. It's there to serve the banks, yeah. Well, that's pretty much why I write. It seems to me that the first thing you have to do is kind of wake people up to what's going on in our system, and then hopefully people organize and do something about it. But they don't know what to do. People feel helpless until they really can put their finger on what's really going on. Once you see what's going on, it's easier to see what the solutions are.
We'll have more with Ellen Brown when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ellen Brown. Ellen, should banking be based on a gold or silver standard?
No, I don't think that works. I mean, we had it based on gold and silver in the 19th century, and then silver was demonetized, and they just went to gold. And it didn't work. I mean, we had I think on average, every 6 years there was a run on the banks because the banks didn't have the gold, and that was particularly obvious in the 1930s when as soon as the banks started to collapse, people rushed into the banks to cash in their paper money for gold. Well, at that time, paper money was, I think, 40% backed by gold. So every time you took $5 into the bank and cashed it out, you would pull $2 worth of gold out, and so the reserves were just disappearing, which meant the banks no longer had the reserves to back their loans. So really what we need to do is, in this modern age, we've gone digital, and virtually all of our money is digital, and you can do much more expansive things with a digital system. You can create money as you need it without trying to find something that you dig out of the ground to back it.
Are cryptos likely to have a place in the currency system going forward?
Well, it depends on how you define crypto, but I would say no. Not cryptocurrencies based on blockchain, which is too slow and too expensive. But we will definitely be going digital. We'll have digital currencies. I mean, we already have digital currencies are the wave of the future. Right now, 95% of the money supply is digital. So if you've got your money in a bank, you're already in digital currencies.
What is the shadow banking system, and is it a concern?
Shadow banks are unregulated banks, so they're not really banks, but they're unregulated financial institutions that we need them, unfortunately. The way our current system is set up, the banks need them because they are pretending to have your deposits at the same time that they have lent that money out. So you've got the problem of Jimmy Stewart in It's a Wonderful Life, where all the neighbors come for their money and he doesn't have it because he's lent it out. So in order to avoid that, what banks do is they borrow. Ideally, they would borrow from other banks, but if other banks don't have it, or if they don't want to lend, or if their rate is too high, then they go to the shadow banking system, which would be like the repo market. But that market can dry up, or you can have runs on the shadow banking system, and there's no regulation. There isn't the sort of regulation that you have on the regular banking system to prevent that. So that is what happened in 2008, and the shadow banking system has gotten quite big again. But until we have another source of liquidity, we need that system. And so that's what we need to do, is replace that source of liquidity, and that's what I've written about, how we could replace it.
Are the derivative markets a real concern or a perceived concern?
Well, again, derivatives serve certain purposes, and many people will argue that they're a good thing, but they're way out of hand. It depends on who you read, but there's at least $500 trillion in derivatives, and some say there's over $2 quadrillion in derivatives out there. So there are many times the GDP of the world out there in derivatives. Derivatives are just bets. So in a sense, it's a good thing because you can hedge your bet. So it was definitely a good thing for farmers who wanted to sell their crops ahead of time because it was something uncertain. So you buy derivatives in order to bet against uncertainty. Like, you're not sure which way the interest rate's going to go, or you're not sure what the exchange rate's going to be. So you can buy derivatives, which puts the risk on somebody else. But the problem is, ultimately, when the system collapses, when the somebody else proves not to have the money, because the whole derivatives thing is, again, it's largely unregulated. Well, you've got over-the-counter, which are unregulated derivatives. When that collapses, when they go bankrupt, which is, again, what happened in the 2008-2009 crisis, then we, the people, wind up holding the bag, and that's the concern. So everybody seems to think Deutsche Bank is the likely problem bank in Europe right now, because they have massive derivatives and nobody knows who's hooked into what. So it's the same sort of scenario as in 2008, where because nobody knows who to lend to. If that collapses, then things could collapse around the world. But on the other hand, I've seen it said. I mean, I only know what I researched, but I've seen it said that they won't let Deutsche Bank go down because they can't. For that reason, they've got to prop it up. But because they can't let these derivative banks go down, or they can't let the whole system go down, they wind up crushing small countries like Greece, forcing them into austerity rather than allowing them to go bankrupt or allowing them to renegotiate their debts or whatever, because you've got to prop up this system at all costs.
If quantitative easing was no longer used, how painful would it be for people, especially the ones drowning in debt?
Well, we've already done quantitative easing. So the government or the central bank owns a lot of the government's debt right now. And the theory was to reverse all that with quantitative tightening. So they were going to be selling, I think, $50 billion worth of bonds back into the market. But what that meant was that if you sell the bonds back into the market, the central bank takes back some money, and the people, the investors, get the bonds. So what you're doing is shrinking the money supply, and that does put pressure on borrowers because that would drive up interest rates. And also, at the same time, they were going to raise interest rates. So they're trying to normalize the markets. But it didn't work. So last fall, the stock market collapsed, or dropped quite a bit, and then investors were concerned, etc. So now they're reversing all that, and no longer trying to do quantitative tightening. And of course, the president keeps telling the central bank that they should be doing quantitative easing instead. So it does look like you can't reverse that stuff. Once you get there, you pretty much have to stay there, and you have to keep doing it. But I would argue we should be doing it. That we should be doing quantitative easing, but the money should be going into the real economy. So you could be doing bonds for infrastructure. You could be doing bonds for buy up the student debt instead of buying up the mortgages. Like they bought up toxic mortgages with the first QE. Buy up student debt and just hold it on the books. That's one possibility. My favorite alternative is to use a form of quantitative easing for a universal basic income, because it just seems like the most fair. If you give everybody a certain amount of money, and you could have this all regulated you could have an algorithm, a computer that figured out how much money we need to put out there every year to fill that gap between debt and the money available to repay it. Everybody would get the same amount, and so you don't have to apply for welfare, prove that you're eligible or something. It's just very simple. It just goes automatically into people's bank accounts. And if they owe debts, it would go automatically to pay down their debts. And that money that paid down debt would be extinguished. So money is created as a loan, and it's extinguished when the loan is paid off. So much of that money would not be inflationary, because it would be extinguished when the debts are paid off. It's been estimated that only about a sixth of a universal basic income would actually go into the real economy, competing for goods and services and potentially driving up prices. But we actually need that. We need that extra money in there to stimulate the economy, to cause producers to produce. They're not going to produce products unless they have customers, and we need those new customers.
One of the arguments against universal income is that there's no incentive to work. Would people just stay home?
So they say, but they've run experiments. They've now done studies in India. There's a massive study in India going on, and they've done studies in Africa, and it's just not true that the people, when people finally have a little money of their own, like particularly women, if you give it to the women, they've never had money before, they use it for education, they start their own businesses, or they use it very productively. And I mean, you could say anybody on Social Security is already on a UBI. And are they lazy? I mean, most people on Social Security are old, and therefore they can't work. But they're not working because they've suddenly got an income. You could say I'm on social. The work I do. I'm not supporting myself really with the work I do, but I've never worked harder in my life. I mean, I'm very motivated because I don't have to worry about paying the rent. All that stuff is already covered. And so I'm out there doing something useful. And I think everybody feels that way. It's much more satisfying to do your real work, your real calling. And a UBI gives people that opportunity to maybe quit a job that they hate and gamble in starting their own business, or just take that time to quit and then look around for another job. If they just have that cushion there, it allows them to do more useful things.
How could government debts and personal debts be wiped out?
Well, it could be done. I was mentioning that the debt jubilees that they did in ancient history, where they literally did wipe out the debts. They just forgave all the debts and said the debtors could go back to their homes, opened the debtors' prisons, let them go back to their lands and farm the lands and work in the service. But we can't do that today. But what we could do is actually give the people the money to pay off their debts. I mean, if you tried to wipe out the debts, the banks would have a fit because that's where they make their money, and it's obviously not fair to the creditors. It wouldn't be fair to the bondholders. But you could give the people the money to pay off their debts. And you wouldn't want to do that all at once, but you dribble it out, put out there as much money as will work with your algorithm that shows how much money, how much new money that the economy actually needs. And you could certainly do that with the federal debt. You could, in theory, you could have the central bank buy up the whole $22 trillion in federal debt, and all it would do would be get rid of the interest, because we never pay off the federal debt, and we don't expect to pay it off. It always goes up, up, up. The real problem is the interest, which grows exponentially, and the interest has to be paid every year. But so it's a big burden on the taxpayers. It's been estimated that in a decade that if the Fed continued with their quantitative tightening, that the interest bill would be $1 trillion a year for the taxpayers, which is huge. We don't need to pay that. If the central bank were holding the federal debt, it returns the interest to the government after deducting its costs, which are not inconsequential. But anyway, for the most part, it would be an interest-free debt, and as long as they didn't say that they didn't insist on having the loans repaid, and they just kept rolling them over, as happens anyway. We roll over the bonds every year. If we just get rid of the interest, then the debt itself really is our money supply. That we've got maybe a negative on one side of the balance sheet, but that money has gone out into the community or into the country, and that's what's running our economy.
Governments in Canada and the U.S. have passed bail-in legislation. What is a bail-in, and where should people put their money to avoid this legalized theft?
Bail-ins were mandated in 2010 in the Dodd-Frank Act in the U.S., but they actually go back to, it was originally the Bank for International Settlements that came out with the resolution for bail-ins. What they are is that governments bailed out the banks in 2008 with actual taxpayer money to start with. Then after that, of course, the central banks did it with liquidity. But originally, the taxpayers, the U.S. taxpayers, paid $700 billion to bail out the banks, and governments globally did not want to do that anymore. So the Bank for International Settlements came out with this new plan. Well, it was actually, I guess, the Basel Committee came out with this new plan that said that they would no longer be governments. Before governments could bail out their banks, the bank would have to bail in the money of its creditors, which meant it would turn its creditors' money into capital for the bank. So basically, it's stealing the creditors' money. And if you are a depositor, depositors are the largest class of creditor of any bank. Now, theoretically, you're protected by FDIC insurance, so as long as you don't have more than $250,000 in an American bank, you would be protected. But even the FDIC has to stand in line. It's the derivatives and the repo market that go first in a bankruptcy. So they could arguably snatch up all the collateral, and there might be nothing left for example, state and local governments that think they're collateralized, that think they're secured with. They do have secured deposits, but their security goes after the derivatives in the repo market. and the FDIC can borrow from the Treasury, but it can borrow up to $500 billion from the Treasury. But there are $10 trillion worth of deposits out there, so there's still a question whether the FDIC itself could go bankrupt. And even if they borrowed that huge chunk of money, who's going to pay that back? It would have to be the banks, which would cripple the banks. Anyway, that it's not a good system, and they have tried it in Europe, in Italy, and the Italian government just rebelled and bailed out the banks anyway, because there was one guy that wound up hanging himself and he left a note on his chest that said this was because this bank that he had trusted had taken I guess he had over 100,000 euros in the bank, and so that was his life savings. Anyway, it's obviously not fair to the creditors, who are just the ordinary depositors who didn't realize that their money was at risk.
I always thought if a bank could dip into your bank account like that, then they should be paying you dividends along the way, but they don't.
Right, they don't pay it. They pay, well, like on my bank account, I get a few pennies every month, and that's their excuse. They say, well, see, we're paying you interest, and therefore you are a creditor.
Do you look at taxes in your new book?
I do. I'm in or what I've written about is a financial transaction tax, which would generate, this is a tax on every transaction. So it would include high-frequency program trading and all those trades, well, stock market trades, that type of thing. But if you're an ordinary stock market investor, you don't trade that much. The ones that would really get hit, and the ones that do a lot of trades, are investors that are playing the market every day, and they're clearly doing it just to make money for money. In other words, their money is not going to the company, it's not helping productivity, it's not really helping anything. They're just siphoning profits off of other people by sharply being in there ahead of other trades. So the U.S. dollar there are $5 trillion in U.S. dollar trades globally every day. So there's a huge amount of money that's traded that isn't taxed. We pay a 10% tax to buy food for the kids or whatever, things that you really need. Well, not food. Usually food isn't taxed. But anyway, you pay a 10% tax on ordinary things, shoes, let's say, for the kids. But these high-frequency broker traders don't pay any tax for their trades. So if you tax those things, you would actually get more money than we are getting from income taxes, which is a relatively small pool. And you could regulate the amount of the tax. It's been calculated that 0.1% would be sufficient to run the government and have money to spare and do a lot of other projects that we currently think we don't have money for. So you could have this very small tax on your trades, and it would also be a mechanism for regulating the money in the money supply, because you could have just an algorithm that figured out how the money supply was, if it was overheating, if kind of like a thermometer, you just have this automatic thermometer that would set the tax. If it started to overheat, maybe it would be 0.11% or something, just a little more to bring a little more money back to keep the money supply in balance with productivity.
Where can people buy your new book, Banking on the People, Democratizing Money in the Digital Age?
Well, it's mostly, you can buy it on Amazon for sure, and Barnes & Noble, and the online type bookstores. You might be able to get it in a regular bookstore, but they'd have to order it. But it's definitely on Amazon. And on my website at ellenbrown.com.
How can people find out more about the Public Banking Institute and your Web of Debt blog?
Public Banking Institute is at publicbankinginstitute.org, and we just provided a lot of information on public banks for people who are interested and ways that you can get involved. And my blog is ellenbrown.com.
Ellen, thank you so much for being on This Week in Money.
Okay, thank you.
My guest has been Ellen Brown, author of the new book, Banking on the People, Democratizing Money in the digital age. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Gerald Celente, Ellen Brown, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Aben Resources President Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, always great to be here.
Larry, with all the interest in the metals used in electric vehicles, what kind of interest has that sparked for your battery recycling?
Well, that is picking up, Jim. And before I get into that, I just want people to realize, because this is going to lead into my main topic here, that, we're working away on stages 3 to 5. That includes new work on a new patentable aspect of the process. So, and it's really necessary. And I want to talk about patents in general. And that is that the company has 2 solid patents with the U.S. patents on the recycling process. We'll have a 3rd application here very soon, and that's what's kind of holding up the results from the test work that's ongoing with 3, 4, and 5. And that's a good thing, because what it's all going to boil down to at the end of the day is just what are your costs of being able to process on a circular economy basis with high integrity of protecting the environment? What is the cost of that going to be, and how is that going to stack up with potential other recyclers? And it's important that we have these patents because the last 2 patents have reduced our costs, and not the last 2 patents, I should say. The last patent and the 3rd one will definitely affect our cost structure, even though it's not high. But it's going to be important that you're able to work in a situation where you're protecting the environment, you have a circular economy, you're not reducing the contamination that's out there, and you're able to do that at a cheaper cost than your potential competition, because there's going to be potential competition. We've gone through the EV car cycle. We're going through the battery gigafactory cycle. And the cycle that's starting to raise its head now and get talked about more is recycling. And we certainly want to be in that field. And where's our initial focus going to be? Well, it really depends on something coming together with potential partners, some of them offshore, some of them onshore. And but the first plant that we build on our own, if it is on our own, and it may not be, will be in the U.S. And why is that important? Well, it's not just that that you're saving the environment. You're solving a problem, or at least you're partially solving a problem which could work into a big solution, and that is the critical metals. And you've got your cobalt, manganese, not so much nickel, certainly lithium. You have those elements out there that are in dire need that the U.S. is almost 100% dependent upon. So on imports, I should say. They don't have any local production. The fastest way they can get local production is through recycling. As you know, it takes time to find deposits. It takes time to develop deposits. It takes time to negotiate with interested parties. It takes time to build the project, or actually to drill the project, and then enter into feasibility studies, and then eventually raise the money and build the project. You could be looking up to 10 years. And that's way too far out in the calendar as far as I'm concerned for what's happening in the world today. There's a lot of uncertainty, and certainly we would want to be part of the solution for the U.S. economy. Remember, our patents are owned by a U.S. company, which is 100% owned subsidiary of American Manganese, Inc. So we have these patents, which I think are probably the most important thing in the company's portfolio. We've spent millions of dollars developing those patents. We've had the lead time on it. We saw the opportunity 3 years ago. Other companies are getting into it just now. We've certainly covered off the basis of what we consider to be the most economic solution out there and the most complete solution out there, like metallurgy, and that comes from a background of mining. So it's, I just want to point out to our shareholders that it's really important that the patents are applied for and issued in order to protect the technology the company has spent a lot of time and money on over the last while. And we feel very confident that nobody should be using any of the methodologies that we use. We'll certainly be looking at other companies that are doing things out there to see if they are infringing on our patents. And so we feel like we're in a very good position. Now, what we can expect is what I would call the third phase of the battery revolution. The first thing was the EV cars. I think there's about 500 of them, 500 companies now developing EVs, and there's hundreds of battery manufacturing facilities and gigafactories going in around the world. And now it's time for recycling to take its place on the stage. And I think we're almost there, Jim. It's just a matter of time, and I think that time is not very far away. We're certainly getting more interest here, and we feel that we want to be a contributor to North America, and on bringing a technology out there that works, that's economic, and it saves the environment.
Larry, where are you traded, and where can people get more information about American Manganese?
We're traded on the Toronto Stock Exchange Venture under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM, where you can get all the information you need by going to our website at AmericanManganeseInc.com. We've got everything up there. And it's easy to navigate, find out exactly where we're sitting, and things that back up anything that I'm saying today. And you can phone us at 778-574-4444, or send me an email at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Hey, thanks, Jim.
Jim, what's the latest with Aben?
Well, we just announced we started drilling. I guess it was probably Saturday we started up in the Yukon on the Justin project. That's a project I added this year. I added so that we could have another month's worth of drilling. to add on. So, we can add that on to the 4 months that we're doing in the Forest Kerr. And it'll increase the news flow, and timing of the news flow through the summer when, that's when things are really happening in the Forest Kerr. But we'll be getting results back from the Justin property starting towards the end of this month and then through July. And then when we start drilling at the beginning of July on the Forest Kerr in the Golden Triangle, those results should start coming out in August and running right through into October, November. So it's a good move.
How long does it take to get results from the drilling?
Well, we're we started with the diamond drill. I thought we'd have the RAB drill ahead of the diamond drill, but we've got the 2 drills up in the Justin. The diamond drill is going to do 6 to 10 holes depending on the meterage that each one's required. Then we've got the RAB drill coming in, which will do 50-meter holes, and we're going to do 20 of them. Those results should start flowing by the end of the month, hopefully, because this time of year the assay labs shouldn't be terribly backed up. And then when we start drilling up in the Forest Kerr, like I just said, we'll transition right into the Forest Kerr, and those results generally start flowing about mid-August. So we're going to have more results sooner, which should be good for the marketplace.
Jim, where are you traded, and how can people get more information about Aben?
Well, we're traded on the venture exchange, tsx.v, under the symbol ABN, and down in the States under the symbol ABN.V. It's on the OTCQB. And you go to the website, AbenResources.com. It's a very good website, got tons of information, so don't be afraid.
Jim, thank you so much for the update.
You bet.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on June 11th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.